Chapter 14, Corporations, Dividends, Retained Earnings, and Income Reporting. Dividends are distributions to stockholders. The dividends can be in the form of cash dividends, property, or stock dividends. Dividends are expressed as a percentage of the par, or stated value, or as a dollar amount. Media General declares a 50-cent per share cash dividend on 100,000 common stock shares. The journal entry on the first date, the declaration date, records the debit to cash dividends, an account that decreases retained earnings. The amount of dividends is calculated by multiplying the 100,000 common shares outstanding by the 50-cent dividend amount. The company records the liability to the stockholders as a credit or increase to the liability account, dividends payable. The stockholders as of December 22nd, the date of record, will be the stockholders who will be paid the dividends. There is no journal entry recorded on the date of record. Media General's payment date is January 20th. As a result of the dividend payment, both the liability dividends payable decreases with a debit because the company no longer owes the stockholders, and the cash also decreases as recorded with a credit. Companies pay dividends to preferred stockholders before common stockholders. Common stockholders receive any remaining amounts after paying the preferred stockholders. If the preferred stock is cumulative, preferred stockholders must be paid any unpaid prior year dividends, also known as dividends in arrears, before common stockholders receive any dividends. On December 31, 2010, IBR has 1,000 outstanding shares of 8% $100 cumulative preferred stock. There are also 50,000 outstanding shares of $10 par value common stock. On December 31, $6,000 of cash dividends are declared. The journal entry reported on December 31st, 2010 is a debit to cash dividends and an increase or credit to dividends payable. The annual preferred dividend amount is $8,000, calculated by multiplying the 1,000 shares by the par amount of $100 by the dividend rate of 8%. As of December 31st, 2010, there are dividends in arrears of $2,000, calculated as the difference between the annual amount of $8,000 and the declared amount of $6,000. To further illustrate, on December 31, 2011, IBR declares a $50,000 dividend. The chart shows that in 2010, all $6,000 of the dividends go to preferred stockholders. In 2011, the $50,000 of total dividends declared will first be allocated to pay dividends in arrears of $2,000, related to 2010 calculated on the previous slide. Next, the preferred stockholders will be paid dividends for the current year of $8,000. After allocating the dividends to preferred stockholders, the remaining $40,000 will go to common stockholders. The journal entry to record the 2011 dividend declaration is once again a debit to cash dividends and a credit to dividends payable. Dividends may be in the form of stock. Instead of receiving cash, stockholders receive additional shares of stock. As is the case with cash dividends, stock dividends reduce retained earnings. However, instead of affecting dividends payable and then cash, stock dividends increase the stockholders' paid-in capital accounts. Corporations may issue stock dividends to satisfy dividend expectations, increase the stock's marketability, or to reinvest in the business. The accounting for the stock dividend will vary depending on the size of the stock dividend. Small stock dividends, less than 20 to 25%, are recorded at fair market value. Large stock dividends are recorded at par value. We will focus on small stock dividends in this course. HH Inc. has 5,000 shares issued and outstanding. The par value is $1, book value is $32, and market value is $40 per share. If the company declares a 10% stock dividend, an additional 500 shares, calculated by multiplying 5,000 shares by 10%, will be issued. At declaration, the following journal entry is recorded. Similar to the recording of cash dividends, the account stock dividends will be debited for the market value of the stock dividend. The market value of $20,000 is calculated by multiplying the additional 500 shares by the market price of $40. The stockholders' equity account common stock dividends distributable is increased or credited at the $500 par amount calculated by multiplying 500 additional shares by $1 par value. The additional paid-in capital account is increased or credited for the amount over par, $39. The amount calculates to $19,500. Recording this amount to the additional paid-in capital account is similar to how stock issuances were recorded in Chapter 13. When the shares of stock have been issued to the stockholders, the journal entry reduces or debits the common stock dividends distributable at the total par amount. Now that the shares have been issued, the common stock account is increased or credited at the par amount. Let's take a look at the stockholders' equity section of the balance sheet. Before the stock dividend, common stock reflects $5,000 calculated by multiplying issued shares of 5,000 by the $1 par value. The paid-in capital in excess of par is $45,000, and retained earnings balance is $110,000. Adding these three amounts results in total stockholders' equity of $160,000. Outstanding shares are 5,000 shares. The book value per share of $32 is calculated by dividing total stockholders' equity of $160,000 by 5,000 shares. After the stock dividend has been declared and issued, the balances of the three stockholders' equity accounts will change. However, note the total stockholders' equity stays the same. The total stockholders' equity both before and after the stock dividend is $160,000. Because 500 new shares were distributed as a result of the stock dividend, there are 5,500 shares issued after the stock dividend. Therefore, the common stock after the dividend is 5,500, calculated by multiplying the 5,500 issued shares by the $1 par value. The paid-in capital in excess of par increases $19,500 as a result of the stock dividend recorded in the journal entry on the previous slide. Retained earnings decreases by the market value of the stock dividend, 500 shares multiplied by the market price of $40. This amount was recorded into stock dividends account in the journal entry on the previous slide. The outstanding shares go from 5,000 shares to 5,500 shares after the stock dividend. Stock splits reduce the market price, do not require a journal entry, and result in a decrease of par value and an increase in the number of shares. HH Inc. has 5,000 shares issued and outstanding. The par value is $1, book value is $32, and the market value is $40. If there is a 2-for-1 stock split, there is no entry, but the par value is now 50 cents per share, calculated by dividing the original $1 par by 2. And shares outstanding are now 10,000, calculated by multiplying 5,000 by 2. All of the stockholders' equity accounts amounts are the same before and after the split. However, the outstanding shares double from 5,000 shares to 10,000 shares after the stock split. The book value per share decreases as a result of the doubled shares, and the par value is cut in half from $1 to 50 cents per share after the split. The retained earnings account reflects net income that a company keeps or retains. Net income increases retained earnings, and a net loss decreases retained earnings. Retained earnings is a part of the stockholder's claim on the assets. Retained earnings increases with credits and therefore has a normal credit balance. A debit balance in retained earnings is referred to as a deficit. A prior period adjustment results from an error made in a previous year, but not discovered until the year has passed. The error may be the result of a mathematical mistake, incorrect application of accounting principles, or other oversight. The corrections are treated as prior period adjustments, and the adjustment is made to the beginning balance of retained earnings. Current year net income will not reflect the correction. Let's look at an illustration of a prior period adjustment. Here is the statement of retained earnings for the year ended December 31, 2010. Before the retained earnings statement is issued, it was discovered that a $5,000 error caused the 2009 inventory to be overstated. The overstated inventory caused the 2009 cost of goods sold to be understated, and therefore 2009 net income was overstated or too high. We saw in the last slide that 2009 net income was overstated. Because this is a statement of retained earnings for 2010, the correction should be made to the beginning retained earnings balance. The January 1, 2010 balance of $1,050,000 is adjusted, decreased, for the $50,000 overstatement. The result is a restated balance January 1, 2010 of $1 million. Next, current year or 2010 net income is added and dividends are subtracted, resulting in ending retained earnings balance as of December 31, 2010 of $1,060,000. To summarize activity that affects the retained earnings account, let's first look at the debits to retained earnings. Debits reduce retained earnings. Activity that reduces retained earnings includes net loss, prior period adjustments for overstatement of net income, both cash and stock dividends reduce retained earnings, and some disposals of treasury stock cause retained earnings to be debited. On the credit side of retained earnings T account are amounts that increase retained earnings. Net income and prior period adjustments for understatement of net income are credited to retained earnings.